Hello, everyone, and welcome into crushthestreet.com. We got a returning guest. Harry Dent is on the line, and he's graciously agreed to come on the show, and I'm so appreciative for that. He's going to help us understand what is going on here in 2020. He has some of the best macro analysis out there. I mean, definitely look into Harry Dent's work in Dent Research. So he's a brilliant mind, and I'm grateful that he's here with us today. So Harry, thanks for coming on Crush the Street with me.
Yeah, great to be here.
So let's just start with kind of how 2019 ended, moving into 2020. I know a lot of people were, conventional money, big money, they were cautious about saying that the market was a good buy, but they definitely were not saying that we were in for a crash. They were saying, hey, they were mostly looking for 2020 to be an up year. And nobody was factoring in this black swan event with the COVID-19 virus. I mean, Ray Dalio, Paul Tudor Jones, all these people, they were cautious, but at the same time, they were overall thinking that things were going to go higher from here. So anyways, obviously we've recovered a lot. And we'll get into that too in terms of like where we were in March and where we are now. But take us through maybe the end of 2019 into 2020 and your analysis, your perspective on this.
Well, first of all, I've been saying since October of 2019, we're in the final orgasmic phase of the technology bubble. Now, the virus hit a little earlier than I thought in March to May, but it hit and people are like, oh, this is just a virus. This is not the virus. This is the trigger for a bigger crash from 11 years of stimulating the economy, keeping zombie companies and zombie, banks going. So this is what's going to hit in the next few months. We're not going to come out of this.
Sure. Well, it's interesting how the markets have moved, and I'll point to just the Google trends. It just so happens that people Googling COVID-19 coronavirus peaked in March, which also peaked in terms of bottoming out of the market. They correlated almost perfectly. And so going into June was a big reopening month for a lot of states and places around the world. Then heading into July, we're starting to see the case numbers spike again, and the worries are starting to pick up. So what are your thoughts on just the sentiment surrounding the market moves and how that's going to play in, or will fundamentals that I think you're referring to and alluding to ultimately going to take over? Or is it going to be a combination of, fear because of some sort of trigger and the fundamentals converging?
Well, it's, I hate to say it, the people that are betting on this in the last stages are the dumb money on Ameritrade and, E-Trade, that all the indicators say they're buying into this the most. That is not a good sign. This market has been going up for 11 years now on artificial stimulus. So it's got a peak here. And I think we're getting close to it here. So don't believe what people think right now. Think the opposite.
It's interesting how in March, the announcements of the stimulus checks and whatnot, going into June, July, we had this record participation in the stock market. A lot of headline news about millennials participating, which on paper, on the surface, I think is positive that people are starting to get involved with savings and whatnot. But it goes along with what you're saying in terms of people buying at the top. And, the millennials have had it kind of rough in a sense, graduating into the '08 crisis, many of them, hard to get jobs, things very, very expensive for this generation. I mean, excited about, riding scooters and living in tiny homes, all these things that, have to accommodate a more expensive lifestyle that may have been afforded, 10, 20, 30, 40, 50 years ago. So speak to that a little bit. I mean, millennials entering the market and just this shock that might be this train that might be headed straight for them in this tunnel.
Well, I would say the millennials are the smart money, the aging baby boomers who own all of these financial assets and real estate and stocks because they're older and that's when you invest the most money. They're the dumb money. The top 100 Fortune companies are buying back their own stock at unbelievable values. That's the dumb money. So I think the millennials are actually the beneficiaries here of a downturn that makes real estate more affordable, mortgage rates, even for a while, more affordable. I think the millennials are going to be the biggest beneficiaries because they don't own these financial assets. They're going to drop 50% in real estate, 70% plus in stocks. I think the millennials are going to come out of this saying, oh, wow, we can invest in the future in stocks to make money, and we can buy houses at affordable prices. Right now, neither, especially if you're a millennial, you have no chance of making money in the stock market at these valuations.
Yeah, it's an interesting dynamic, that's for sure. There's a lot of headline news right now with the discussion of fundamentals disconnecting from valuations. I mean, and we're seeing that. I mean, Warren Buffett was sidelined. I've been repeating this time and time again, not buying the dip in March because clearly the fundamentals didn't line up. But there's this disconnect of what the Fed's doing, the government's doing that is manipulating the stock market higher. And it's creating a casino in the stock market, if you will. So maybe address that, if you would, this fundamentals, because I think that's what you're talking about. These 50% drops, that's inevitable. It should happen, but it's not happening in the timeline many would hope for or assume would be reasonable.
Yeah, there is no timeline for this, except I have a 90-year cycle for super bubbles, 1837 to 1842, 1929 to 1932 in stocks. This is the cycle that this, these
Uh-oh, did I lose you?
Oh, yeah.
Let me. So Harry, right now, I did some research before this interview. The Texas unemployment benefits on the high end are $521 per week. That's normal benefits. Now on the low end, it's $69 per week, which works out to $276 a month. And then with the federal, they're getting $2,400 a month additional. So, I mean, it's a huge benefit for a lot of people who lost their jobs. And so, again, going back to the fundamentals, it really seems like this whole economy is dependent on just this easy money that's just lubricating the supply chains, the velocity of money, if you will. But how long can this last for? I mean, PPP isn't going to last forever. We had 40 million people plus lose their job during this crisis. And that's with a tremendous amounts of support and stimulus and injections into the economy. So if they continue, do you see this continuing to just continue to string this along, or does it end, and what's the fallout?
Okay, I mean, we're getting at the extreme phase, which I've been predicting for years, where they have to print so much money, 3 times what they did from 2009 to 2014, in the QE phase, and 3 times the fiscal stimulus from $1 trillion to $4 trillion, and there's more coming in this short period of time. What does it take to keep the bubble going? You can't keep it going past the point. This is the end stage of the bubble. So you have to decide, where do you get out? I would say right now at 10,650 on the NASDAQ 100, that's the top of this channel. In this bubble, it could be higher or lower, but I'd say get out now, run and take your money, including real estate.
Harry, I'm curious what your thoughts, and I think you already alluded to this. You know, the tech sector has recovered even more than it was pre-COVID. Do you anticipate that the tech stocks are going to fare better in this crash than the general equities, the other sectors? And maybe just comment on that. Or do you continue to see Amazon, Google, Facebook, Zoom, Netflix being a place that people gravitate towards and support higher valuations?
Well, great question. This is going to accelerate the move from online to everyday business. People are going to work less online versus in the office, but it still is just temporary on this crisis. I think that Amazon's going to go down here when things finally peak, and the tech stocks as well, because the overall market is peaking here on my longer term indicators. So I think we're at a major peak. This is the hurrah from the virus, but it's not the economy is going to be okay. The economy will not get back to where it was in 3 months ago.
Yeah, and good point. And then, and just to reiterate the question too, and I appreciate that answer as well. But more specifically, do you see tech stocks moving down more than overall equities as a larger percentage of that move down?
Okay. Yes. In the early stages, the tech stocks hold up the best. In the later stages of this crash, they go down the most because they're the most overvalued. So yes, I like treasury bonds in the early stages here to be safe, and then AAA bonds and corporate. But yes, in the end, the tech stocks will go down 80 to 90%, including Amazon.
Harry, what are your thoughts on gold here? Now over $1,800 solidly, kind of bounced up against that $1,800 resistance level for some time now. Here we are as we do this interview, gold materially over $1,800. What do you make of gold in this environment? Why is it moving higher?
Well, gold has always been the greatest offshoot indicator. I still think gold is peaking here in a bear market rally into $1,800, which was the 3 tops in 2011 to 12. So that's strong resistance. I think gold does not break up here because it senses the deflationary impact. Gold is an inflationary investment. It's not a deflationary one. So if gold does break up above 1820 convincingly, I'm like, okay, maybe it goes higher. But why hasn't gold gone up? With the dollar down 6 to 7% and all this money printing, I'm telling you, the dollar and the gold senses weakness here.
And so the dollar versus other foreign currencies, What do you make of this global crisis, and the dynamic of what's going on with the U.S. as it compares to what the rest of the world is doing? Can you give us just your general analysis on that? And does it benefit the dollar if the rest of the world is falling at a quicker rate, or is the U.S. Falling at a faster rate than maybe some other comparisons around the world?
Okay. My position for 20 years now is that the dollar is the best house in a bad neighborhood. Everybody's printing money to get out of this crisis. Everybody's doing the stupid thing economically. But the US has printed less than the Eurozone and way less than Japan compared to their GDP and economy. So, but in this recent reaction to the coronavirus, the US has printed $3.45 trillion in a matter of months in QE, on top of the,
Absolutely. Yeah, no, and I tend to agree with that. It's a position that changed over time. I mean, in the early days when I was kind of getting out of college and learning about a lot of this, I was very much of the Peter Schiff mindset. I adopted it that, the US was going to fall away, and then, China would take over Europe, and and the US would fall in relation to everyone else, and they would just decouple and move on. But that's just not the way things are playing out. We have a world acting in unison, and it just seems like the world is pegged to the US and continues to act in a worse fashion than the US. So I think it's really interesting. I know that the US has bailed out a lot of these airline companies. They're bailing out a lot of businesses, but how is that faring, for a lot of the other countries, which aren't necessarily bailing out companies, though? I know they're printing, their balance sheets, but they're not, injecting it into the companies the way the U.S. is. So, I mean, do you have any thoughts on this?
well, again, the US was the best house in a bad neighborhood in the past since 2009. We printed less money, 24% of GDP versus 42% for Europe and 108% for Japan. Now we are the leader. We have printed $3 trillion in fiscal stimulus, 2.45 trillion in just the last few months. In quantitative easing, we're the leader. And that's why the dollar is going down. But it's not going down as much as most people would suspect, because we're still the best house in a bad neighborhood. If you look at the peak of monetary printing, which we're now leading, we're like at 33% of GDP. Europe was at 42%, and Japan's at 108% and rising. Who's the worst house? Therefore, the US dollar, being the reserve currency, being, I don't know, 24, 25 aircraft carriers, whatever, we're the best house in the bad neighborhood. So currencies trade relative to each other. People don't understand that. It's not like a stock that has 10 years of earnings discounted at 10-year treasury bond yields. There's not a real value to currencies. They trade relative. We're the best house. Now, in the next crisis, because we're overstimulating, the dollar could continue to go down for several months. But in the end, it will go up 20 to 30%, as it did in late 2008 to 9.
Yeah, my goodness. Imagine the next crisis. And are you referring to just the next leg down, which maybe you expect to happen in the next couple months here? Or are you talking, 5 to 7 years from now, when instead of printing $5 trillion or whatever it is, cumulatively between fiscal and monetary. I mean, what does the next crisis look like 5 to 7 years from now? I mean, they're printing 10 or 20 trillion dollars. My goodness. I mean, I can't even wrap my mind around what that environment might look like.
Okay, the next crisis looks like late 1930 to 32, the greatest crash in stocks in the Great Depression. You deleverage debt. We've been waiting forever to deleverage all the zombie companies and zombie debts and banks. No, like Japan originally and now us and Europe. Oh no, we don't let that happen. This is bad business. Bad business. Listen to me. I have turned around businesses. I've consulted to businesses, Fortune 100 down to entrepreneurial. If you don't deal with your stuff, if you don't deal with over expansion, you die. This is what's happening in our economy and will happen. So this will happen in the next 2 years. The key time period is late 2020 to late 2022 for the stock markets and into 2023 for the economy on a lag. That's the worst downturn we will see in our lifetimes. If that doesn't happen, I'll quit my profession.
Harry, I think we'll end it right there. I appreciate your time here with us. Please let everyone know where they can go to find you, what they can expect to find. And I suppose there's no conference you'll be speaking at next week, you know, where everyone can meet you in Miami or something like that. But I mean, anything you'd like to share, please do so. And again, thank you so much for joining me today once again.
Well, again, we always say we have a different point of view. Go to harrydent.com, get on our free daily newsletter, just put in your web address and you're done. But hsdent.com for more information about us.
Thank you so much, Harry. Appreciate your time with us here.